Hello students, I am Ms. Payroll and today we will learn about the matching principle and the economic entity assumption.
You are now under our control, puny humans.
You will obey our orders now or face the consequences.
Please don't kill us.
Yeah, we still don't know anything about accounting.
You know, they have a point. We should let them learn about this. It's important.
We don't need to know about matching principle or economic entity assumption. Accounting is boring anyways. Who cares? I don't like this kid. He's annoying. Goodbye. We have decided to spare your lives as long as you teach us this principle stuff. Seems important.
Okay, we will. Just please don't hurt us.
Yeah, whatever. Just get on with it.
Alright, so the matching principle is one of the main GAAPs that accountants use every day to ensure that their company's financial reports are accurate.
What's an accountant?
Who cares? Just listen.
The matching principle states that all expenses are recorded in the same time period that they help produce revenue in.
What does that even mean?
So basically, revenue is when a business sells merchandise or a service to customers and they get money for doing that work. To help the business sell more, they have expenses that help produce or promote their product or service. The matching principle says that when reporting these expenses and revenues, they must be in the same fiscal period so that you don't mislead the reader of the financial reports.
But what's the point of doing that?
Well, if a business were to record their expenses in another fiscal period, it would make their net income look larger than it actually is. This is bad because you need to tell the full truth in your financial statements. If a company forgets to record an expense for the 2014 fiscal period and decides to put it into the 2015 fiscal period, they are in violation of the matching principle. This is because those 2014 expenses helped make revenue in 2014.
Oh, okay, that makes sense. That would make your 2014 net income look better than it was and your 2015 net income look lower than it actually was.
Exactly!
Alright, now what's the economic entity assumption?
Well, that's my area of expertise. The economic entity assumption is another one of the major GAAPs accountants use on a daily basis. This assumption states that all activities of an entity are kept separately from the owner's activity or any other entity they may own. There shouldn't be any events that do not pertain to the business on the financial statements.
What's an entity?
That's a good question. An entity can be an organization or unit in society. Some examples of entities are companies, governmental units, a municipality, a native band council, a school board, a sporting event, or a club.
We want another example.
Okay, say you own a business and you need to pay the rent for your own personal apartment. This business is your main source of income, so you need to pay yourself with the money that the business earns. To correctly take out money from the business to pay for personal items, you would debit your drawings account and then credit your bank account to show that you are taking money out. This does not violate the economic entity assumption because the owner's personal matters are not recorded on the financial statement. However, if the owner were to debit rent expense and credit bank, this would be a violation because now the business is paying the rent for the owner's personal property. This personal property is not helping generate revenue and therefore should not be included in the financial statements.
So this just means that you need to keep your personal and business separate from each other.
Yeah, that's what that means.
Well, that's all we know about the GAAPs.
So you'll keep your promise and not kill us?
You humans did teach us something, and we do appreciate that.
But it was useless to our mission, so goodbye.
Oh dear, that's not good.